So good morning, everybody. I want to talk about the fragility of stablecoins and how to design a stablecoin. So we want to dive a bit deeper into the topics we have heard before. It's a perfect match. So thank you to the organizer. So maybe I start with the background, the personal background. So I have a PhD in engineering. I switched to banking. Maybe you ask yourself why an engineer goes to the bank in the banking sector. The topic is banking is mostly about mathematics, and especially in risk management and balance sheet management. It's mathematics, so we applied the tools of engineering in the bank. It was an interesting phase. It was during the last financial crisis, so I was there 2006 to 11. So it was there to learn very much about the financial sector, and I want to present you some insights about this experience. Later, I came to the government of Liechtenstein. So I'm from Liechtenstein, and I was at the VP Bank is the third biggest bank of Liechtenstein. My job was to support the Prime Minister in terms of financial innovation, digitalization, blockchain. So the Liechtenstein Blockchain Act, the Token Act, this is one of my projects. And today, I founded, we are running two companies. One is Some Group. It's about a technology-based bank. We are in the licensing phase currently, so it's in stealth modes. We don't communicate at all. So, but if you listen carefully to my presentation, you see some parts of our vision of some group that we will do in the future. What I can say is that we are doing this bank in Vienna. That might be also interesting for some of you. The second company is PROSYD. And PROSYD is a software as a service company. We are providing software for banks, financial intermediaries. Of course, we are also doing the software some banks are using. And we are doing our own software because the software is the fundament of the future banking. So we cannot do a technology bank without the proper software. And we are also doing risk management tools that are using the tools of engineering and try to make a better risk management than banks usually do. The timing of this presentation, so when I finished this presentation, it was about 2 weeks ago. And often in crypto space, it's the case that my presentation is overtaken by the events that happened. So who has heard about stream finance? Okay, not all. So there was a case that just proves what I want to show you in my presentation afterwards. But I want to talk today about the stablecoins. The stream finance stablecoin is one a very special one with a complex investment strategy. But this part of the financial sector is not new. So if you know, at the end of the 90s, we had a hedge fund that was run by Nobel Prize winners, the LTCM. Andrew knows it. And it's kind of the same system. If you just trust too much the wrong mathematical models, it will fail. And so I'm very happy that Bluechip organizes this kind of conferences, because it's really necessary to have a closer look at all kinds of stablecoins, because the name is not really true in every case. So I want to start with a recap of the financial crisis. It's long ago. It started in 2007. But based on that, I want to explain you how the banking sector is working, and then to the bridge about the working or functioning of the stablecoins. So the financial crisis started with a subprime mortgage crisis. So we had US banks giving mortgages or credits to more or less poor people. So because the bank said we want to carry those risks by ourselves, they put that in a SPV, special purpose vehicles, created securities out of these SPVs that are called mortgage-backed securities. And based on some weird mathematical models, they decided, okay, some part of those securities are AAA rated, even if the essence of those SPVs are still subprime mortgage, so very low rated mortgages. And in addition to that, they just did the same process about 27 times. So we had a huge bunch of securities in the world that have been sold to banks throughout the world. Especially European banks have bought those securities in a large amount because they have been AAA rated with a high yields. So that's the paradise for every banker. Then a collapse of Lehman Brothers was one of the major banks in that economy. They collapsed and just pushed a shockwave throughout the financial system. We had a stock market crash. We had the bank runs in several countries. So the problem was that this collapse of other banks in other countries triggered the governments that they had to save the banks. So the banking crisis went into a state crisis. So the state debt of Greece and Portugal and other countries increased. So we had a huge economic crisis coming from that trigger point of this subprime mortgage crisis in the USA. So this is the intro. I hope that we'll then have never to see such a scenario again, because it was highly interesting, but it was awful. Also to see how fragile the financial system is. And one part of this financial system is the interbank market. And just want to explain you shortly about the interbank market, because not many people know how banks and the banking sector is really functioning. So if you bring, there's a bit split. If you bring your deposits, so your cash to a bank, you have the cash in a bank account, but it's not the idea that the bank is holding this cash in its vault. It's not like in Harry Potter with Gringotts. It's more you give the bank a credit, you have a liability. The bank has a liability to you. The bank is using this money, it's offering mortgages and credits to companies, buy securities, and if there is more refinancing or liabilities in the balance sheet, then the bank can use on the asset side. It's used on the interbank market. So the bank is lending the money on your bank accounts to other banks. So if many people withdraw the funds from a bank, so of course, they first stop the interbank markets, then they sell the securities, but usually the credit business cannot be stopped. So in that case, the bank would be insolvent. But usually in normal market circumstances, the bank can lend from other banks via the interbank market. And so the interbank market is, from a systemic point of view, kind of a complex network about global lending of cash between banks. But you see here in this picture, if one bank like Lehman Brothers collapses, it usually triggers the avalanche effect that we have seen in the last financial crisis that accelerates a crisis. So the role of the interbank market indeed was an acceleration, so a fire accelerator of the financial crisis. So usually the interbank market is short term, so 1 week, overnight, 1 week, 1 day, to maximum 1 year. So the role of, you have to understand the role of risk managers, as I was at the time, is to make a real-time monitoring of the input data that comes in. So we have input data from Bloomberg, there was some market data providers from the news, and we try to find out if the bank, our counterparties have problems. So, and as soon as we have indicators that there are problems, we stop the lending to the bank. We have to stop to protect our bank. But this means for the other bank, if there is a rumor, it's like a self-fulfilling prophecy. The bank will collapse because it runs out of funds. Because it's like a what's this the word? Regenschirm. Umbrella when it closes if it starts to rain. Thank you. So, so in the case of a bank run, the interbank market is not a solution because the risk managers of the bank are always faster than the private client. So the umbrella is always already closed if the retail clients realize that there is a problem. And so that's the reason why the interbank market has proven as a fire accelerator in 2008. Now we come to the structure of the stablecoins. Now we leave the banking sector and we come to the stablecoin, but it's quite similar. So if we have talked about Tether before, so if you own a stablecoin like Tether or Circle, it's again a liability from a certain entity. In the case of Tether, it's public information. It's a Tether International. It looks like a Cayman entity. And the entity has reserve funds that holds those assets, but there's also an operational business. We have heard before about this number of people that obviously work in this entity, and they have operational assets also. And if you look at the details of these reserve assets now, that's a bit special, but I want to just guide you a bit through those kind of positions Tether has. This is the Tether. Later on, we look at that Circle. So Tether has used treasury bills. That is a credit to the U.S. government, short-term credits, which is I would expect in such a structure. They have reverse repo agreements. We talk later about that. What this is a bit a special product. They have money market funds. Non-US treasury bills, which is a bit special if you talk about currency risks, corporate bonds, precious metals, Bitcoin, other investments, and secured loans. So if you look at the other big stablecoin is Circle, I wanted to show you the details about EuroCircle, but it was not public. So I switched to the USDC, which is transparent. So the asset manager BlackRock is publishing the real-time information about the holdings. And you see here it's a bit small, but you see here they mainly have three-party FICC, what they say, and treasury bills. I'll talk later about the three-party FICC, that you understand what it is. But you see here they have this asset disposition. They have a yield coupon about 4%. We talk later about that. So they earn 4% for the money you have. And we have learned yesterday that it's not allowed to, under the Genius Act, to pay interest rates. So their profit is about 4% minimum. So what is a reverse repo and three-party repo? So in the last financial crisis, we have learned that uncovered interbank market is a bit risky. So if a bank collapses, you have problems. So the banking sector started to adopt a system that has been known by central banks to lend money from central banks. That's like the reverse repo agreement. That works like if I lend money to another bank or an asset manager or funds, it offers me collaterals, usually securities, hopefully good rated government debt securities. But it's and so in case the creditor is insolvent, I can access the securities, and so I have no problem. So usually that's a very good idea. It helps to reduce the risks of the interbanking market. This three-party agreement has a special situation because another investment bank, in this case it was Goldman Sachs, looked on the operational process so that the lender can be sure that the securities are really there, and in the case of a bankruptcy of the creditor, everything is in order. So the very good point of such structures is there are very low operational risks, so you can rely on that because it's a regulated entity. It's securities-backed lending. So in terms of standard risk management, that's a good idea. The negative part is you still have certain risks, like if the securities risk, so if the coverage of the securities is impacted by the market price risks, if the interest rates change, there is a rating downgrade, there's a default in the coverage, you still have, might be under coverage in such a structure. And this is especially bad if this is parallel to the default of the creditor. So there can be, and I experienced that there can be situations where the structure is worthless, especially if those the securities are Lehman Brothers high-graded papers. So it happened. It was there in the last financial crisis. Because there is a certain creativity about just going around those risk management measures. So if you look at as a summary, I mean, I'm really looking at the very conservative stablecoins that are out there. So this is USDT and USDC they have learned after the event of this Silicon Valley Bank. So before, as we heard before, the structure was much worse, and now the structure is still there. It's not the stream finance topic, because this is another form of stablecoins which is far beyond such a structure. But if you look at such a structure, it's similar to banks. So this is a typical bank has exactly the same risk structure, a bit more credits to retail clients or consumers or mortgages and so on. But the difference is that stablecoins are actively traded. That means that makes the deposit business similar to the interbanking market. So in fact, and this is what we experience every week, rumors, fears, and increased risks immediately are mirrored in the market price. And this is kind of the ingredients, to my experience, that can help to accelerate the next financial crisis. And I mean, this is the slide that could be replaced with the stream finance case, because if you look at, I think it was Silicon Valley Bank at that time. It was March 2023. So in this graph, we see a loss about not very much. But it's always interesting to look at the details. So if you scroll in, zoom in, you see that circle dropped about 20% within some minutes. So and I mean this the coin of this week it dropped about 70%. So it's still worse. So this means that if something happens and there are rumors around, the price can drop quite quickly. So we need to consider that. I mean, that there are scenarios around that can affect the stability or the fragility of stablecoins. It means if the US government rating is downgraded, which has happened, in fact, in the last weeks, if there is an increase of the key interest rates of the Fed, if the default of securities issue in this reverse repo contract, so there are some scenarios that could be risky for the stablecoins. And if there are rumors around, it could have a severe impact on the withdrawal of funds and also on the market price. For fun, as an engineer, I like numbers, so I just calculated the risk sensitivity of USDT and USDC. You see here. So the risk sensitivity of the USDT of US government rating downgrade is -5%. That means that if the impact of a rating downgrade is more than -5% on the securities they're holding, the USDT is not covered anymore. And USDC is even tighter, so it's only 0.5% that are sufficient so that if a rating downgrade affects is more than 0.5% on those instruments, it's not covered anymore. So and there is a kind of a black box of these repo securities. You don't know really what's inside. I'm a bit worried about that. So if there is really the Lehman AAA rated Lehman Brothers papers and that's reverse repo agreements, then we can have a problem in the future. Yeah, I think I can shortcut this slide a bit, but there are risks like reverse repo risk, the treasury bill. Treasury bills are a good idea to invest because they're highly liquid. You can sell them. Sorry, the idea of this slide, I need to go into this slide. The idea is about the liquidity risk of stablecoins. So what happens if many people are withdrawing their funds from such a structure? I mean, reverse repo is okay. You can just stop those contracts. Usually, they are not so long-term, but it's a question if the counterparty is able to repay the funds. Can trigger the impact on other counterparties that have liquidity problems. So it's like can have an impact on the interbank market or on the financial market. Treasury bills are better because they are very liquid, are traded, but the problem is the current market price. If there is something in the market price, you can have a different price than it's in the portfolio. And a bank account, if we have heard yesterday a lot about the beauty of having money on a bank account. I mean, if the bank is insolvent, goes into bankruptcy, then this money is at risk, and it depends on this insurance or a deposit insurance scheme if this is really still there or not. So you have to be cautious in the case of the bank accounts with a correspondence bank. But I would say in general, from a financial perspective, we have heard before the presentation it was more about the whole picture of the structures. Is it segregated in case of bankruptcy? But here I'm looking just at the financial picture. I would say in usual market environments, those stablecoins are rather okay from a stability. The problem is more in an extraordinary market environment. And the big question is, could they accelerate the financial crisis? So if there is a bank run, with those structures, other financial intermediaries could be affected. And so a rapid and broad withdrawal of liquidity can bring its counterparties into trouble and trigger an avalanche effect. And this is the true problem I see with such kind of stablecoins. So in case of a problem, we can have a big problem. So the other point I want to, this is the picture of financial market stability. The other problem is the impact on mass adoption. So the stablecoins are there to be used, so they can be a good idea to be used in the digital economy to make digital payments. But imagine if you want to pay something and it's 70% less, so it could increase the number here. So it's not worth to use that. So if you know that your money is not valuable anymore, if you want to use it, then it's not ready for mass adoption. And so that's the reason why I think for real-world application, if you want to see this development to mass adoption of stablecoins, we need to design a 100% stable coin. Before I come to that topic, I just want to cover this idea of stablecoins based on bank deposits. So there is even some banks are discussing that as another product or another version of the stablecoins of USDC and USDT. But in principle, we have to see that bank deposits are quite close to the stablecoins risk we have seen before, because the banks are working like the structures I've presented before. But usually, the bank deposit clients does not see what the bank is doing. So risk managers, as I've been, we see from the market information in real time what is the market estimation of a bank, so we can react on that. But the typical private client or the retail client does not see that. So, but if we start to trade that, the deposits, and create a stable coin that is backed by bank deposits, then we come into a version where this issue what we have seen with Circle can also come with a deposit-backed stablecoin from a bank. So if there are rumors around, and it's not so far. If in Switzerland, we have seen the case of Credit Suisse, which was the second largest bank in Switzerland, a huge bank. They had a huge problem. They collapsed. Basically, they had a liquidity problem. And so the rumors around that, before that, they had a long history of credit problems. So they had obviously a bad reputation in that. And the market knew that, and there was another problem, and so the people started to withdraw the funds. If you have a stable coin that is issued by Credit Suisse, backed by bank deposits of Credit Suisse, I mean, this would accelerate this crisis of such a bank in 1 second. So that's not really a good solution, to my opinion. So, and now I come to the to the solution. And I mean, it might not be sexy, but what we need is not a sexy stablecoin we just need a safe, anti-fragile stablecoin. It must be completely risk-free, no liquidity risk, so I can withdraw the funds and exchange that at any second. And if everybody wants to withdraw that, it must be liquid enough to fulfill all all the requirements. No market price risks, no default risks, and one-to-one price stability in each situation in the market of the financial sector. So the solution is that we choose a setup that we have no maturity transformation. This is that what banks are doing in the balance sheet, that they fund long-term credits with short-term liabilities. It must be, to my opinion, 100% central bank's money, no interbank money or other forms of money. Because if you have money on a bank account, we have again the same problems I've described before. So a stablecoin must be backed one-to-one by central bank's money. And it must be 100% liquid, so if everybody withdraw his money, the issuer cannot be affected. So we are very sure that this money is just as safe as possible. And one topic we have learned before, it must be segregated from the bankruptcy realm. So in case the issuer, the bank, is bankrupt, you must not have any effect on your structure, on your assets. So I think I leave a bit time for discussion and question. So some years before, I wrote a book. I had the idea to write a book about stable money. It's about what we can learn from Bitcoin, Libra, and Co. I think when did I write that? About 3 years ago or 4 years ago. But the charts can be more actual, but it's I think the messages are there. And if you want to learn a bit more about the vision I have for the future financial system, to create a stable financial system, you can find the ideas there. And this is also where we want to go with some bank, or some banks, because we believe that a stable financial system is just the fundament of everything we are doing in the future. So if you have not a stable financial system, the ones that paid the bill at the end are everybody, the citizens, our children that have to repay the bill for the next decades and so on. So thank you for your attention.